Good day, ladies and gentlemen, and welcome to the second quarter 2014 Oxford Resource Partners Earnings Conference Call. My name is Kim, and I will be your operator for today. At this time, all participants are in a listen-only mode. Later, we will conduct a question-and-answer session. If at any time you require operator assistance, please press star 0, and an operator will be happy to assist you. As a reminder, this conference is being recorded for replay purposes. I would now like to turn the conference over to your host for today, Mr. Brad Luke, Investor Relations Representative. Please proceed.
Thanks, Kim. Good morning and welcome to our second quarter 2014 earnings conference call. We appreciate your continued interest in Oxford Resource Partners. I'm Brad Luke, Investor Relations Representative with Oxford. Participating on the call today are Oxford's President and Chief Executive Officer, Chuck Ungerling, Oxford's Senior Vice President of Operations, Greg Hanisch, and Oxford's Senior Vice President and Chief Financial Officer, Brad Harris. Earlier this morning, Oxford released its second quarter 2014 results. On today's call, we will be discussing our operations and financial performance for the quarter. Following our prepared remarks, we will open the call up to questions. Please be aware that some of our remarks may include statements that are not historical in nature and that may involve expectations, plans, and objectives regarding future operations. These remarks are subject to the cautionary language regarding forward-looking statements contained in our press release. Additionally, we will be discussing adjusted EBITDA and adjusted net loss, which are non-GAAP financial measures. The definitions of adjusted EBITDA and adjusted net loss and reconciliations thereof to net loss, the most comparable GAAP financial measure, are included in tables presented near the end of our press release. Our press release has been posted on our website, oxfordresources.com, and furnished to the SEC in a Form 8-K filing. With that, I would like to turn the call over to Chuck for some opening remarks. Chuck?
Thanks, Brad, and thanks everyone for joining us today. While coal markets continue to present challenges, we are pleased to report second quarter results that are in line with our expectations. We're particularly pleased to report that we have settled the Big Rivers lawsuit. The settlement of $19.5 million substantially compensates us for our lost profits from the wrongful termination of our coal supply agreement. We are scheduled to receive the settlement payment by mid-August. As Brad will discuss, this will enable us to pay down our first lien debt, saving us interest expense. It will also enhance our liquidity. And now turning to sales. As we discussed on our last call, the increased coal burn that resulted from the extreme winter weather, coupled with low utility stockpiles, has created additional sales opportunities. However, these opportunities have been somewhat tempered by a mild summer and below $4 natural gas prices. Despite this tempering, we recently executed 2 additional spot orders for approximately 60,000 tons each. We are now 98.1% committed and priced for 2014. Should additional demand materialize, we have the ability to increase production by up to 500,000 tons annually with little additional CapEx investment. We have also locked in some additional tons for 2015. Our projected sales volume for 2015 is now 69.8% committed, with 12.3% of the projected sales volume priced and 57.5% of the projected sales volume unpriced. As a reminder, a majority of the unpriced tons for 15 will be priced at the end of this year based on an index calculation. Now, I'll turn the call over to Greg to provide an update on our mining operations. Greg?
Okay, I'd like to start with a review of our safety performance. Our MSHA reportable incident rate for the second quarter was 1.0, which is 54% better than the average for Appalachian Basin mines. Our incident rate for the first half of the year was also 1.0. Now that's a 41% improvement over the first half of 2013. Running safe operations is fundamental to achieving our business objectives. really proud of our employees' performance in this critical aspect of our operations. Now, regarding production. Second quarter production was ahead of expectations. Productivity continues to run ahead of last year's levels, due in part to the addition of a second contract highwall miner during the first quarter of this year. Significant events during the quarter included the initial development work on 2 new mines in our Belmont and New Lexington complexes. These mines will replace production from 2 depleting mines in our Belmont and Cadiz complexes. Finally, regarding permitting activities, we were issued 1 new mine permit in the second quarter covering 1.3 million tons of coal. This keeps us on pace to achieve issuance of mine permits on roughly 8 million tons of coal in 2014. And with that, I'll turn the call over to Brad. Brad?
Thanks, Greg. Good morning, everyone. For the second quarter of 2014, coal sales revenues increased 2.5% over the prior year period to $52.49 per ton. However, cash cost of coal sales increased 3.4% to $44.38 per ton, primarily due to higher diesel fuel costs. The net impact was a slight decrease in our second quarter 2014 cash margin. Our cash margin for the quarter decreased to $8.11 per ton from $8.28 per ton for the second quarter of 2013. Tons sold in the second quarter of 2014 decreased by 158,000 tons over the prior year period to 1.5 million tons. The decrease in tons sold was primarily attributable to the idling of our Illinois Basin operations. For the quarter, total revenues were $82 million, including $79.6 million from coal sales. Comparatively, second quarter 2013 revenues totaled $88.1 million, including $85.7 million from coal sales. Adjusted EBITDA was $13 million for the second quarter of 2014 compared to $13.9 million for the prior year period. Depreciation, depletion, and amortization expense was $10.1 million for the second quarter of 2014 compared to $12.8 million for the second quarter of 2013. Second quarter 2014 SG&A was $3.3 million, down from $5.8 million in the prior year period. Last year's second quarter SG&A included expenses related to our debt restructuring. In the second quarter, we recorded a $763,000 gain, primarily related to the sale of excess land that had been fully mined out at our Belmont complex. Interest expense was $2.6 million higher for the second quarter of 2014, primarily due to higher interest rates and amortization of costs associated with our new credit facilities. And lastly, we recorded a $1.9 million non-cash gain in the second quarter of 2014 related to the change in fair value of the warrants associated with our second lien credit facility. CapEx totaled $3.2 million during the second quarter of 2014. Maintenance CapEx continues to benefit from the use of our Illinois Basin equipment relocated to our Northern App operations. As of June 30th, 2014, we had $3.5 million of cash and $7 million in available borrowing capacity on our revolving credit line, an improvement of $2.9 million over the first quarter. We also have the option under our second lien credit facility for an additional $10 million term loan if requested by us and approved by the issuing second lien lender. And as Chuck mentioned, we are to receive $19.5 million from the settlement of the Big Rivers litigation. We anticipate paying down between $12.5 and $17.5 million on our first lien debt, leaving $2 million to $7 million to further enhance our liquidity. Additionally, the pay down of debt will save us $1 to $1.4 million in cash interest expense on an annual basis. And now for our updated 2014 guidance. We expect to produce between 5.7 and 5.9 million tons and we expect to sell between 5.8 and 6 million tons. Our average selling price is expected to be in the range of $52.30 to $53.30 per ton, and our average cost is expected to be in the range of $44.50 to $45.50 per ton. Adjusted EBITDA for the year is expected to be in the range of $38.5 million to $42.5 million, not including the Big River settlement. The decrease from our previous guidance reflects the impact of higher diesel fuel costs. And finally, we anticipate CapEx to be between $18 and $20 million. With that, I'll open the call up for questions. Kim?
Thank you. Ladies and gentlemen, if you would like to ask a question, please press star 1 on your phone. If your question has been answered or you would like to withdraw your question, please press star 2. Questions will be taken in the order received. Please press star 1 to begin. Your first question comes from the line of Sam Dubinsky from Wells Fargo. Please proceed.
Hey guys, just a couple of quick ones. In terms of your guidance, you raised your mining cost guidance slightly. Is this a steady state run rate as we look into 2015, or are there any levers to get this down?
It's Chuck here, Sam. It's largely driven by diesel fuel. We feel that everything else, we've got well under control, and we don't anticipate any large increases or decreases. I would say it's pretty much steady state.
Okay, great. And can you also just run me through your cash flow projections through 2015? How much cash burn do you think you'll have?
I would think our liquidity will be very consistent between where it is now and between the end of the year, between our cash flow generated from operations and obviously our investing and finance requirements. So I think you can expect where we are right now or where we are at the end of the first quarter, somewhere in that level to be consistent with what we expect.
Okay. And just anecdotally, it seems like coal markets are marginally better on the thermal side. As you look into next year, are there any potential positive surprises? I know we've been through a series of sort of negative surprises. Anything that can go right next year based on what you see today?
Well, I think, unfortunately, it's largely going to be weather dependent to a certain degree. Have another winter like we had this year, and it would be a pleasant surprise. For our perspective, the fact that, we're well contracted with scrub power plants, I think is a big plus for Oxford. None of the plants that we currently supply are scheduled to be closed down next year, so I think that's our best news for us.
Okay, great. Thank you very much.
Okay, thank you, ladies and gentlemen. That concludes our question and answer session. I will now turn the conference back to Chuck for closing remarks.
Thanks again, everyone, for your ongoing support of Oxford. We look forward to sharing our progress with you on our next earnings call.
Ladies and gentlemen, that concludes today's conference. Thank you for your participation. You may now disconnect and have a great day.